Hello, welcome back everyone. In this video, we're going to continue with Chapter 5 on compounding and the time value of money. We'll be using Google Sheets to show you how to do the time value of money calculations. So please pause the video now and open up Google Sheet, a new one, so that you can follow along with the calculations and the examples. Let's get started. So here are the 5 functions that we'll use throughout the demonstration. To find the future value, the name of the function is FV, and all functions start with a parenthesis. So we'll go over how to use them through examples. To find the present value, the name of the function is PV. To find the rate of return, the name of the function is rate. And to find the number of time period is NPER. It actually stands for number of periods, so NPER, number of periods. And to find the annuity payment, the function name is PMT. The name of these functions is the same for Excel and for Google Sheets. To use this function, we need to give this function something to do, and those are called input variables or arguments. Unlike the function names, the input variable names are different for Excel versus Google Sheets. And I've color-coded them. The names for Excel is in purple, and the names for Google Sheets are in red. So the rate of return is the same, is RATE. But for time unit, Excel call it NPER, and Google Sheet call it number of periods with underscore connecting the words. For annuity payment is PMT for Excel and payment amount for Google. I encourage you to print out this page so that it's easier for you to reference. All these are relatively straightforward. Rate of return, time period, annuity payment, present value, future value. The last input variable is a little bit more confusing. It's called annuity type. So in Excel, the name is typed. In Google, it's called end or beginning. So this means that they're trying to distinguish whether the annuity you're entering is an ordinary annuity, where all the payments occur at the end, or an annuity payment, where all the payments occur at the beginning of the time period. So zero means that all the payments occur at the end. So this will be ordinary annuity. So if you are working with an ordinary annuity, put the number 0 in this variable. If you are working with an annuity deal, you'll put the number 1 in this variable annuity type. Since most problems that you work with are going to be ordinary annuity, that's considered the default. So if you don't put anything, meaning omit any entry into this input variable, Excel and Google Sheets will assume that you're working with an ordinary annuity. One last thing that spreadsheets such as Excel and Google Sheets assume is whether a cash flow is an inflow or an outflow. We'll use a negative sign to denote an outflow. So this is money leaving your pocket. If all this seems a little bit confusing or overwhelming, don't worry. We're going to go over many examples to demonstrate how to use this. Let's take one of them. Say you want to find the future value, meaning the ending value of the investment. The function you're going to use is FV. And if you're doing this in Google, the FV function will have these input variables. You have to tell Google what is the interest rate, how long the time period for this investment, and the annuity payment amount, the present value, and whether the annuity payment is an ending or a beginning. So these are the input that you need to put into the function for it to work. If you're using Excel, it's very similar. The argument name is different, but the value is the same. So all the demonstration that we do, you can apply it in Excel as well. Let's start with a future value example. Jordan, this is from the textbook as well. Jordan received $2,000 as a gift, and they are going to save the money. They open an IRA, an individual retirement account. They expect to earn 11% per year, And they wanted to know if they leave this money in the account for 40 years, how much would that money grow to? Let's identify the different components of this problem. The $2,000 is money that Jordan received. So this is money that they have today. Money that they have today is the present value. They expect to earn 11%. The 11% is the interest rate. They plan to invest the money for 40 years. So 40 years is the time unit. And you want to estimate the value of this in 40 years. So you are asked to find the future value. The function we'll use is the future value function, or FV. The first input variable is the interest rate, which is the 11%. The second is the number of period, which is 40 years. We don't have any annuity payment. We do have a present value of $2,000. Since we don't have any annuity payment, we don't have to worry about the type. So to repeat, the interest rate is 11%, which is 0.11. The number of period is 40. The payment amount, we don't have any annuity payment, so that's 0. The present value is $2,000. We're going to enter that as negative, so minus 2,000. And we can leave it blank because we're not working with any annuity. So what you will put into the spreadsheet will be something like this. The future value, so we start all functions with an equal sign. So you type equal, and then FV is the function name, open parenthesis, and the rest of this. So pause the video and enter this formula into your Google Sheet. Welcome back. Did you get $130,002? Congratulations, you just did your first future value calculation. You may wonder why we put in minus 2,000. We put in minus 2,000 because we assume we're taking $2,000 out of our pocket and put it into the bank. And then in 40 years, we can take $130,000 back out from the bank. You can try entering 2,000 and omit the negative sign, so just put $2,000 in. You should get negative $130,002 in result. The reason is the algorithm assumes that if you get $2,000 today, you have to pay back $130,000 in the future. So if you sacrifice or invest $2,000 today, you'll get back $130,000 in the future. Let's take a look at present value. In finance, the term value actually usually refers to present value. When we want to talk about future value, we'll say compute the future value. Earlier, we said that the process of computing present value is called discounting. It answers the question, how much do I have to invest today to reach a particular goal in the future? This is a really common financial planning problem, so you can see the value of present value calculation. Here's another example from your textbook. Jordan's company offered a retention bonus of $15,000 if they stay with the firm for 3 years. There is a competitor, and the competitor said, well, we'll offer you $12,000 today. If they change job, they can invest the sign-on bonus and earn 8%. The question is, well, how can Jordan compare the $12,000 that they could get today versus the $15,000 that they could get in 3 years? One approach is to compute the present value of the retention bonus. So important, we are not looking at the competition today yet, so we're going to ignore this for now. We're just looking at the retention bonus. So we know we're going to get $15,000 in 3 years. And the opportunity cost is the 8%. To do the present value calculation, we're going to use the present value function, PV. The first argument is rate. The interest rate is our opportunity cost. So that's the 8%. 8% is 0.08. The next is the number of period, just to wait 3 years, so that's 3. There is no annuity payment, So that's 0. And the future value is the retention bonus of $15,000. Again, since we don't have annuity, we can leave the type as blank. You enter, once again, start with the equal sign. Whenever we use a function in the spreadsheet, we start with an equal sign. The function is PV, and these are the input value. Pause the video and put this into your own worksheet. Welcome back. Did you get 11,907? So this is what you can compare to the sign-on bonus. Since the value of the retention bonus, the $15,000 in year 3, is worth only $11,900 today, the sign-on bonus of $12,000 is higher. Not a whole lot higher, but it's still higher. In the textbook, in an early example, we claimed that by saving a few $100s per month, it can grow to over $1 million in 40 years. Sam was very interested, so his goal is to have $1.5 million by the time he turned age 70. He's right now 25 years old, and he is planning on investing in the stock market through mutual funds, and they expect to earn 10% per year. His question is, how much does he have to save per month to reach his goal? Sam's goal of reaching $1.5 million is the future value. They are currently they wanted to have this amount by the time they turn 70. They're currently 25 years old. That means they have 45 years to save this amount. So 70 minus 25 is 45. So that's 45 years. That's important. Sam is planning on saving each month. So if we multiply 12, so there are 12 months per year of 45 years, that means they will have 540 months to save. Their interest rate is 10% per year, but he's saving every month. So we need to convert that to on a per month basis. So 10% per year divided by 12 will give you the interest rate per month. The function that Sam will be using is the PMT function. So PMT is the annuity payment. So the first argument is interest rate, where they say that will be 10% per year divided by 12. So you can enter that directly into the spreadsheet. The next is number of period. You can enter 45 times 12 as well, or you can enter 540 months. The present value, they do not have any money saved today, so that will be 0. The future value is how much they want to have. They want to have $1.5 million. We're going to leave this blank. That means that we're assuming that Sam is going to save at the end of each month. You can also enter the number 0. 0 or blank will have the same effect. Once again, to start the function, you start with the equal sign, and that's the PMT function. First input is the interest rate, number of months, present value, future value, and assuming an ordinary annuity. Pause the video and enter this into your workbook. Did you get 145 or minus 145? Or 43? This means that Sam is negative, means this is money that Sam have to put away. So if Sam is able to put away $143 per month, by the time they turn 70, they'll have $1.5 million in the bank. The next example is a time horizon problem. I encourage you to pause the video and read this problem on your own just to test how well you can decipher this problem. This is an example in the textbook. We are continuing with a previous discussion where Sam had made some unwise choices and have racked up $8,000 in credit card debt. The card carries a 24% interest per year, and Sam had been making the minimum payment, but that's not going to cut it. So they decided that they would try to pay $225 per month. The question is, how long will it take for Sam to pay off the entire $8,000? So the $8,000 is how much they owe today. So how much they owe today is the present value. $250 per month. So this is accrue. Anytime you see per month, that's a good chance that that is going to be their monthly payment. So that's the annuity payment amount. The function we'll be using is NPER. Notice that this is per month. So the interest rate is 24%, but that's per year. So we need to divide that by 12. The payment amount we know is $250. That is an outflow, is negative because that's money we're paying out. The present value, this is how much you owe today, is $8,000. Future value is 0. It's 0 because they want to pay off the entire amount. If they have any balance left, that will go into the future value. But he wants to pay it off. That means he wants the future balance to be 0. So that's why future value is 0. And we're going to leave it blank because assume that the credit card payment is due at the end of each month. Starting with an equal sign, this is what you will enter. The function name is NPER. It's 24%.24 divided by 12 is the interest rate. Minus 250 is the payment. Positive 8,000 is the present value. The inflow versus outflow assumption in this case is very important. If you forget to turn this into a negative number, you'll get an error message. You can try it out, and if you get an error message, don't panic. Just go back and put a negative number here, and you will get the right answer. Pause and try it out. Did you get 52, 59? So that is 53 months. That's a long time. So 53 months is well over 4 years. Sam wonders if he doubled the payment, monthly payment from $250 to $500, how long will it take? Pause the video, give it a try yourself first, and then come back and see the answer. The input variables are similar. The interest rate stayed the same, 24% per year divided by 12 months. But the payment amount now is minus $500 instead of minus $250. Balance did not change. Future value didn't change. Everything is the same. And it turns out that that will reduce the time period from 53 months to 19 months. So by doubling the payment, you can reduce the time it takes to pay off by more than half. So originally, it would take over 4 years. By doubling the payment amount, they can pay off the entire balance in less than 2 years. This is part of the power of compounding. So sooner you pay off your loan, the less interest you accumulate. The earlier you start saving, the more money you accumulate. We're going to pause the video here. We will continue examining how we can use spreadsheet to help to compute time value of money problems in the next video. See you soon.